And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Are you ready to make a bet on single stock ETFs? The first U.S. single stock ETFs launched at the end of last week. Access launched 8 of them that enable an investor to make bullish or bearish bets on 5 well-known big-cap companies: Tesla, NVIDIA, PayPal, Nike, and Pfizer. Now, how do they work? Well, let's ask Greg Bassick. He's the CEO of Access Investments. My old pal, Dave Nautic, financial futurist at VettaFi, also joining us as well. Greg, this is the first single stock ETFs in the U.S. There's 8 of them. Got to get this out of the way. Tell us how they work. What are you getting when you get these ETFs?
Well, that's right, Bob. These ETFs are designed to provide amplified exposure on single stocks like Tesla, NVIDIA, and some of the others that you mentioned. They're designed for active traders who are making daily decisions based on earnings and other corporate events for which these tactical solutions are important. While this market has matured for leveraged ETFs, we're excited to bring the first single stock ETFs here to the U.S.
So we're putting up what these are here with their symbols here, and I'm just struck by the fact that they're not all the same. Like you have Nike 2 times bull, 2 times bear, and Pfizer 2 times bull, 2 times bear. But Tesla, you just have a bear. So I presume this means that if Tesla stock is up 1%, this would be down 1%. It's the inverse of it. But they're all different. Now, how did you decide on the different degrees of bull bear? What made you decide on what ones you're doing here?
Yeah, no, great question. Look, the first thing that we decided to do was to come out with ETFs that are based on stocks that are very actively traded and stocks that around these corporate events, tactical, experienced traders want to make those kinds of decisions. With respect to ETF innovation, we've been doing that for many years, and it's always a balance between coming out with better tools for investors and doing it within the regulatory constraints. So you take a stock like Tesla, which happens to be, very volatile itself. We thought rolling out the inverse first would be, the best way to roll these out. And we've done that with other funds in our family as well, where we'll start with the inverse and then we'll move to either different leverage factors or other elements of the innovation.
Now, as always with these leverage and inverse products, we always qualify them. They reset every day, folks. So even over a few days, the actual return will differ. So the SEC, Greg, has not been very friendly to these products. Just last week, SEC Chair Gary Gensler said, I'm quoting him, they are risky products for investors and potentially for the markets as well. Other SEC officials have also expressed concerns. In your opinion, do these products pose some kind of risk to investors and to the markets? And what have you said to the SEC about this?
Well, look, as I said at the outset, these are definitely tools for active traders. These are not buy and hold investments. These are not building blocks for portfolios. But one thing that is increasingly clear is that the market for these kind of strategies is very well developed, and the investor universe for these kind of ETFs, both here in the U.S., although before our launch, not for single stock ETFs, but you look to other major markets like Europe, and there's a very mature market for these kind of strategies. Now, having said all of that, we also agree with the premise that these products, like other investment products, investors need to know what they're investing in. And so we've gone to pretty great lengths to provide that kind of disclosure and education so that these are used by the right investors as important tools for those traders.
Yeah, Dave, how many years have we been talking about leverage and inverse products? We're getting old.
About 20 at this point, I think.
Yeah. So let me just take this up. We've seen leverage problems cause some problems in the past.
With volatility.
The volatility one that occupied your time so much 3 or 4 years ago, and mine, to my regret. Give us your thoughts on these products. Is there some? It's odd to me that Gensler actually tried to not front run, but comment ahead of the products?
Well, several folks at the SEC came out basically saying these products are very sharp tools in the drawer. And that, like all these leveraged and inverse products, you have to think of these as being razor blades in your toolbox. If you have a need for this specific use case, you've got an exposure, you're like Tesla or Netflix, and you're trying to play the event for some particular trading strategy, then these are going to be great. And I give Access props for figuring out how to do the structure in a US regulated environment. My concerns are that people don't read the labels well enough. They don't necessarily understand that you cannot hold these things for a week or two. It's really true with all leveraged and inverse products. It's super true with these because obviously as a single stock around an event, it's going to be much more volatile than a basket of 500 stocks around an event. And that volatility kills your returns.
So other than that, other than the usual warnings that nobody reads the labels and they'll get confused about what you're really owning and all of that in the reset, how about the specific issue of single stock risks? If these things get big enough, could they pose a problem to the individual stocks underlying it? Could it cause volatility? And is it possible that there's even some kind of systemic risk, a broader risk to the overall market?
The risk here is, as we saw with the volatility products, if, for instance, one of these products got very large, let's imagine there's a GameStop one of these, and then the GameStop one gets to be very large, a significant percentage of the AUM of the underlying stock. Every day, the long and short versions have to buy with the market, meaning if GameStop's up on the day, they have to buy more. If GameStop's down and they have to sell more, and that adds volatility to the end of the market.
So you've got this bear Tesla. So for example, what actually what's the mechanics of what happens at the end of the day?
Every day when they reset, they need to reset that exposure. If they were short and Tesla is down, they actually need to lighten up that exposure. They need to be sellers of more exposure while Tesla's going down. On the opposite side, if Tesla's going up, they're going to have to be net buyers, or in that case, unwinding shorts, same thing. That can create that end-of-day increased volatility.
Greg, are we just being paranoid here? I mean, these are, you use swap products, right, to work this out, right? But could there be a single stock risk if these things got too big?
Well, I go back to the notion that this is a very mature market, and we haven't seen that with respect to these kind of products. At every step of the way, over 15 or probably 20 years, as the ETF market has evolved to new areas of innovation, we always hear concerns about that with respect to volatility or systemic risks. One thing that gets us excited, as we look to continue to innovate in the area of ETFs is ETFs as a vehicle has remained very, very resilient. One other thought I would share with you is that, buying and using leverage, that's also been around for, many, many years. And the traditional ways of doing that, such as, buying on margin with itself, comes with some limitations and risks. For example, investors that buy on margin could potentially lose more than their initial investment, whereas this ETF, single stock ETF, in that regard, we believe is a better mousetrap in that investors can't lose more than they're investing. So it's another reason why we were really focused on innovating in this area.
So just to extend my paranoia a little further on this, is there a systemic risk here? I mean, suppose this product was phenomenally successful.
Yeah, so that's
the entire S&P 500 had 2 times, leveraged, bull and bear, leveraged and inverse ETFs surrounding.
Yeah, so we've seen this in the case of volatility. When the VIX products became a significant part of the available Vega in the options market, the actual volatility we were trying to trade, it did become a problem. It became a tail wagging the dog problem. Now, we'd have to have enormous success. I think Greg would be happy to retire on the amount of success that might be required.
Yeah, he's going to retire. We're going to have to clean up this mess and explain it to everybody.
But the point is, there is some opportunity for these things to get out of hand. Now, we're talking about huge mega cap stocks. He's right that this does have a point solution difference for traders that are looking for that kind of negative exposure without taking that margin risk. Those are all accurate statements. In 3 or 4 years, if there's hundreds of billions of dollars in this complex, then we're going to have a different conversation.
Yeah, and the SEC will probably get more active, right? I mean, look at the comments they're making with nothing. There's no real volume in these things. There's not a lot of assets under management, and already they're they're making comments.
Like anything else on Wall Street, when there's no volume, there tends to be no systemic risk. When the volume gets out of hand, that's when you start to look for the cracks in the system.
You know, last week, Dave, I had on Bruce Levine from NightShares, formerly from Wisdom Tree, a friend of ours, and he started a whole company that's essentially out there tracking overnight returns.
Yeah.
They're buying at the close and they're selling at the open. And it seems to me now we have funds chasing single stock returns here. Is this a sign that speculative products are becoming more commonplace, or is this a natural evolution?
It's not even an evolution, it's old home week. I mean, remember, back in the 90s, the first ETF products were exclusively trading vehicles. Nobody used them for buy and hold. They were used by institutions to do overnight cash management. What we're seeing now is this rise of a new class of trading products. It makes a ton of sense. We've had a new class of retail trader come into the market in the last couple of years. Of course, we're going to get product chasing that market. At the same time, I point out we still have traditional buy and hold, low-cost beta being released by issuers every day with great opportunities for expansion. So we're going to continue to bifurcate this market. Some products are going to be appropriate for retail traders. Some products aren't.
Right. And just move a little bit here. Most of the inflows continue to be boring, plain vanilla, S&P 500. I mean, I know we focus on these little niche products because intellectually they're interesting to you and me. But the truth is, most of the world doesn't pay any attention to this, right? So there are, just summarized, I have Dr. Noddick here who knows all things on flows. Money's still going into.
Money's still going in. It's still going in predominantly 80% of it's still going into cheap, low-cost beta. It's going into fixed income. It's going into treasuries. It's going into international and developed equities, exactly like you would expect. And during this last 6 months, we've seen investors use tools to do things like get exposure to dividends again because they're looking for income sources. Get exposure to inflation plays like Greg's own product, PPI, right? Great product mixing in commodities and inflation-sensitive equities and tips. All sorts of great products out there that are long-term buy and hold, very different than inverse Tesla.
Yeah, and I want to ask you about that, Greg, before we go, but about your new products. But I just want to know, there's already single stock leverage and inverse ETFs to trade in Europe. How long have they been trading, and what kind of history do they have in terms of influencing volatility?
Yeah, great question. So the market for these products happens to be quite mature. They've been trading in Europe for a number of years. And the growth in assets also is very reflective, we believe, in the demand, again, by these kind of more active traders. The other thing I would share is that we have not seen those kind of systemic risks and the other challenges that you pose for these single stock ETFs. In the US, I would make the same comment, which is that while single stock ETFs had not been available before our launch last week, the market has really matured. You know, it started out with broad-based indexes, then sectors, then industries, but even 2x and 3x leveraged single commodities like oil, had been available previously. We just really took that structure, the leveraged ETF, and we provided, as Dave put it, another tool in the toolbox for active investors.
Yeah. Now, you got approval for 18 of these, as I understand, but you only launched 8. Can you give us a preview? What are the other 10, and when are they going to launch?
Yeah, no, absolutely. All of the ETFs that we got approved and that we're excited to bring to market here in this first tranche all go back to being very actively traded, but particularly of great interest among traders when there are different news and announcements, things like earnings. And so the other single stock ETFs that we included in that tranche represent other industries. So ConocoPhillips, another leader in the space that it plays in, but where investors want to make tactical decisions on a daily basis with respect to those kind of developments. And so to your point, we have 18 in this first tranche. And to be honest, we're most excited about the pipeline behind those, not only in the single stock ETF areas, but other areas where we believe there's still a lot of white space in ETF development.
Like what?
Well, look, you mentioned PPI before. This is the first ETF that in a single investment, you get both exposure to a range of asset class that in a single way, tips and commodities had been used as inflation hedge, while at the same time, you also have investments that tend to do well in rising price environments like cyclical stocks. So we look at areas where investors have, certain challenges, and where in the efficiency and ease of the ETF wrapper, we can bring that new development to the market.
Yeah, I guess my question would be, sort of, Pfizer to me is not an obvious choice for a leverage and inverse ETF. I mean, Apple maybe, AMD. Do you choose based on beta, or what is it? What is the decision process there? If you make it simple, because I'm a simple guy. Okay.
Bob, this one is a great case study. So Pfizer is a category leader. It is a very actively traded stock for those that want exposure to that sector. But interestingly, in a situation like we just saw, the FDA looking to give pharmacists the ability to give out the COVID pill, there are active traders that might, express a view on Pfizer, bullish or bearish, but want to trade on that news. And so that's a great case study of why these single stock ETFs represent important tools for traders that want to go down to the single stock level.
Yeah, so I guess the question is, how much of an appetite? Is there a vast appetite for these leverage and inverse? These guys, thank you, I'm here all week. These guys, Access, I have to say, have been pretty innovative.
Yeah, they have.
Besides the PPI, I was mentioning this inflation, they've got the long, short Cathie Wood.
Yeah, I think the challenge is going to be staying ahead of consumer sentiment, right? Because it may be that people want to be trading Pfizer FDA announcement. Makes total sense to me. But tomorrow, it could be an Apple earnings announcement, and 3 weeks from now, there could be something going on at 3M that we haven't talked about in years, right? So being ahead of that so that these products are available and liquid and have vibrant markets before investors really want to turn to them is going to be a challenge. I think what it means eventually, Bob, is we're going to end up with every stock in the S&P 500 with a set of 2 or 3 products against it, probably with 2 or 3 competitors, which means we're going to get thousands of these tickers over the next
too many stock
decade.
symbols. I already got too many of these things up there.
You'll retire.
They had a long, short... Thanks. They had a long, short K-Web, right? Long, short to China ETF, our friend who runs K-Web. So, Greg, I have to say, you've been fairly innovative, about figuring this out. One of the things that Dave and I always like is how quickly ETFs pick up on the mean. The zeitgeist in the air. Remember, 4 years ago it was pot stocks, and then it was crypto, and we were buying. There was nothing to buy, and they were still creating ETFs. Buy NVIDIA.
There we go.
It's amazing how creative the ETF business.
Well, yeah, I mean, it's, as our friend Matt Hogan used to say, it's almost like a manifest destiny of ETFs. There shall be an ETF for every exposure.
But in a way, okay, we're running out of all sorts of ideas. Well, then let's do long, short of everything.
Yeah.
We got enough China ETFs.
Got a couple thousand more of those
China
to go.
ETFs.
Yeah.
You can multiply this infinitely.
We're just running risk through the transmogrifier and spitting it out in different packages.
I'm still concerned
You're a little
about
saucy
single
about
stock ETFs. I'm sorry, but great, congratulations on getting the products launched. Direxim is also got
coming
products
up soon,
coming,
and Granite Chairs coming behind that.
Is coming too. All right. Well, I'm sure we'll talk about them as well, because that's what we do here, folks. That does it. But what do you think I'm here for? That does it for this week's ETF Edge. My thanks to Greg and Dave. And we've asked Dave to stick around and give us his thoughts on action in the second half of the year for the ETF Edge podcast. We're going to be talking about the state of indexing, crypto, and ESG. Remember, that's not gone away. And remember, you can see all of our shows on the website. It's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.